All right, folks, thanks for joining me today. My name is Eric Wilkinson with Pro Trader Strategies, and I'm going to be doing this section on swing trades. We're going to actually look at different charts, find some swing trade patterns, hopefully, and then look at that based on our assumption we come up with from that analysis, find the optimal option strategy for that assumption. So we aren't just picking option strategies out of the hat. We are looking at these internals of this underlying, and then we are going to find the optimal option strategies. So I'm going to try and get you folks to a place where options just make sense. You ever heard of that little story about, you give a man a fish, you feed him for a day? Well, I've geared this course to introduce traders and investors like you folks to implement options around their portfolio. And I'm sure this old floor trader can even teach the savviest of traders a thing or two. And options can be intimidating, I'm not going to lie, but I build from simple concepts to real life examples. And by the end of this, you folks should have a solid understanding of options. My goal is to get you to a place where you know options and understand them intuitively. And I think I can do that relatively quickly. So, folks, I believe you are smart people and you want to become smarter. So I'm going to show you how we can make these options really simple, and there's no more going to the store to get some fish, all right? All right, so first off, we are going to be talking about the swing trades and using short put spreads around these swing trades that we find. Now, what is a swing trade? Ultimately, let's talk about that. A swing trade is anything, folks, that lasts longer than 2 days. A trade that you put on that lasts 2 days or more, to be quite honest. It's usually considered to be less than 6 months, but for the most part, it's basically over 2 days. And a day trade versus a day trade is intraday, all right? So swing trade's pretty simple. We are looking for a longer duration. We're not looking for or at 1 minute charts and stuff like that and trying to make some swing trades intraday. We are looking for longer duration swing trades here. All right, so the swing trade, like I mentioned, it's going to last longer than a couple of days. And then what we're going to do is, actually here, let me do a chart here real quick. So what is a swing trade? Swing trades is basically when we're looking at the charts, and we'll see different things happening on the charts, like, you could see something happening like this where you have a market move like that. You could have something where it kind of goes like this, right, sideways, or you could have something that is doing that, right? Ultimately, what we want to do is to determine the trend. Bullish, right? We got a sideways pattern here, and we have a bearish pattern here. So we determine the trend. When we're looking at swing trades, we need to determine that first. We have to find those key things that are going to determine a trend. Higher highs, higher lows is a bullish trend. Lower highs, lower lows is a bearish trend, right? And then we have sideways trends where we are going to then go and try and find support and resistance. So we can find resistance here, here, and here, right? So you draw a line. We got a resistance line. We got support here. And then we find our resistance and supports on a sideways trend. So the steps is first determine the trend. Second, find your support and resistances. And then we find the pattern within the trend. This is a bullish pattern, right? We have a bullish pattern. Bullish trend, I should say, bullish trend. But inside that bullish trend, we have a bearish pattern, right? So when we're looking at swing trades, determine the trend, find your support and resistance, and then find the pattern within that trend. For instance, we've got our resistances here. We got our supports here. We've got our bearish trend with a bullish pattern within that trend, okay? So those are things we're going to constantly be looking at when we are trying to determine swing trades. And a lot of you guys, I'm sure, have tried swing trades where you're looking at indicators and stuff like that. But what happens in a situation where we were looking at something like that, where we have a trend and then the market's coming up, right? Starts rolling over. We've determined we've got a bullish trend. We've got our resistances, and we found our supports here. and you put on a trade for this to start rolling over, and it does that, right? Sideways, all of a sudden it goes like that. I don't care if you got a bearish thing going on and it gaps down, and then it continues when you thought it was going to go higher, right? All of those things we have seen happen with swing trades. They aren't 100% right all the time, folks. They will help us turn that table in our favor for getting directionality right, because we will see support resistances, and those will hold true most of the time. But there are times that it doesn't work out, and we find ourselves scrambling to trying to get out of these trades. Maybe your stop gets hit on a gap, on something that gaps, right? Your stop is going to be executed way down here, right? To get out of it if you thought it was going to start moving back up and it drops to gap down. Well, that's a problem. You don't know exactly where you're getting out when you have stops that are just going to get executed at the market. The beauty in options is you can keep your powder dry, folks. You can stay in these trades a little bit longer because of the nature of these options. You having the right but not the obligation to do what the options would entail. Being a call, if I have a call, I have the right but not the obligation to buy the stock. A put, if I buy a put, I have the right but not the obligation to sell that stock, right? So if it gaps in either direction, when we have option strategies on, it gives us a little bit more time to be right. And sometimes we can even be directionally wrong with options and still make money, folks. That's why we want to use options around these. When we're using stocks or the ETF, the outright underlying, if the market moves, we are beholden to that. The beauty in options is we could have a move that is not following our directional assumption, at least right away, and still make money. All right, so that's why we would want to implement options around a strategy. For instance, we could determine that, this was a resistance area, this was a support area. It is going to start breaking down sometimes through these areas, as we have found before, right? It will want to revert back down into those areas of this sideways trend for this underlying. But sometimes if you had gotten in right here, you would have gotten stopped out and maybe missed the move on the next downturn, or you were afraid to get involved in. A lot of times, if these patterns get broken, we get stopped out a couple times, that third time we might be shy, and that's the one that works. That, again, is another aspect of options. It allows you to stay in these trades a little bit longer. If you guys remember with me with this IBM trade, I put it on based on a swing trade. It broke that pattern. Well, I was able to stay in that trade a little bit longer because it was a defined risk trade, and I knew where my levels were. Okay, so it wasn't pressing the thumb screws on me as if I was short this underlying and it broke that pattern. I would be a little bit more trigger happy trying to get out of this underlying. So when we're using options, we can stay in them because we know our risk, we know our reward. All right, so let's move on. When we're talking about a swing trade and we have determined, first things we have to do is identify the trend, identify the support and resistance, and probably most importantly, identifying the pattern within the trend, folks, because that will give us our swing trade, right? We're not necessarily identifying a swing trade based on an overall arching long-term trend. All right, we are trying to get these little moves within the overall trend. All right, so once we've determined the overall longer-term trend, we find those support and resistances. That's where we are going to be looking to enter into a trade. And then once we identify that pattern within, that gives us our bullish or bearish assumption on the swing trade, okay? So why would we use options? Well, I kind of mentioned this a couple of times. You got better odds. So we talked about when you're using a swing trade, you're turning the table in your favor a little bit because you have a probability of this market rebounding, right? Well, with options, we can get better strike location and allow ourselves a little wiggle room in order to be right. So we aren't risking as much as we would for one with going out there and buying the underlying. You're going to have to put up a lot more money using just a stock or ETF. I don't care if you're on margin or not. It's still cheaper to do it with options. You're going to increase your odds by using options, and you're going to allow yourself to keep your powder dry because you're going to have less risk on. You're not going to be as antsy. You're not going to be as worried about this underlying because of these options. And the beauty in, the options having defined risk. We know what our risk reward is, all right, most times. All right, so again, looking at swing trades, on this one, it's pretty obvious. We've got that sideways market that's kind of moving like this, right? So we have identified a sideways trend here. We've got a sideways trend. We've got our resistances. We've got our support area. Actually, our support's probably a better line right there, sorry. And our support area, all right? And we would have determined that the pattern within the trend would have been bearish for this one, right? Again, we could go over to something like the E-mini S&Ps. We've got our resistance. We've got our support. We've got our bullish trend, right? And we've got a bullish pattern within that trend, all right? Now, bearish patterns, you could look at it this way, where you're looking at the market kind of breaking that pattern. We might be actually getting into a sideways here where there's really nice defined support here and resistance up here, right? And it looks like we are starting to find a bottom here. So it's a little bit early. It's not confirmed, right? We do have a bit of a bottom pattern there. So we could say we've got a sideways trend here. We found our support area, and it looks like the pattern within the trend is starting to revert back to the upside. So I am one of those guys, folks, that gets involved in options trades on these swing patterns a little bit earlier. I don't always wait for them to get confirmed. But with that said, I would play this to the upside and look at something right around here at around the 75, just say 75 even, would be my area where I would get out. All right, that would be my out because it would break below the support area and that candle that I was using as a setup for this swing trade. And then we could look at something, if you want something that would be like a little bit less risky, then we could look at something like this one where we are having a bullish trend, right? We bounced off the bullish trend and it looks like we are getting confirmation of a bullish pattern within that trend. All right, so these are different setups that we could look at. Here we would look at this area as being a support area, this area as being like a resistance area. I could draw some lines in there that are straighter for you, but you guys get the gist. I would be looking for it to trade up towards, the upper band there on a swing type trade. All right, so let's talk about some options real quick. What are options? First off, right? Some of you folks might not have traded options, or at least not very much. I mentioned this one. The call buyer has the right but not the obligation to buy the stock. That's the beauty in buying an option. You have to pay for that opportunity, though. Now, as the seller of the option, you receive money, but you, by receiving that money, take on the obligation to sell that stock or to deliver that stock to somebody. On puts, if you're a put buyer, that gives you the right but not the obligation to sell stock, all right, or to short that stock at that strike level. Whereas the put seller has the obligation to take delivery, meaning he has the obligation to buy at that strike, all right? So when you are a buyer, you have to give away money in order to receive that right. And when you receive that money, you give that right, all right? So there's always a give and take with options. And we're going to be using both of these we're going to be buying one and selling one today. So we're going to be talking about this a little bit more as we go along. But one thing with options, right? I talked about there is a premium involved in trading options. And we all see that in the option montage, which is on this page. We'll talk about this in a minute. Like all of these numbers are what you would have to pay for the options. But what we need to determine is if these option prices, you know, what I would pay for any given strike in the options, are they cheap or are they expensive? Right? Because when I'm buying something, I want to know if I'm paying up for it, if I'm getting it super cheap, right? We all want to buy cheap and sell when it's expensive. And we can do that in the options, all right? We can determine whether these prices are expensive or cheap through, yes, it's a Greek, it's Vega, all right? Don't run away. We are going to talk about these Greeks, but I'm going to make it very simple for you folks. Vega is just implied volatility. So if you ever see me write implied I'm not talking volume, volatility, okay? Implied volatility is Vega, and we have it both for the calls over here and for the puts here. So this is just implied volatility, and we'll see implied volatility more often than we'll see Vega written around, but they're one and the same. So what we want to do is we have to look at this number in order to determine whether that number is high or low, okay? Now, we aren't talking VIX here. We're talking volatility, but we aren't talking the VIX. We're talking about implied volatility for this particular underlying, okay? And this number will give us a reference as to where this underlying has seen its implied volatility before. And that's really important because just like we are finding support and resistances in swing trades, we can see where those support and resistances come in. We will see that same thing happen with, probably even more so, with implied volatility than we will even with this underlying. So what we would do is we look at implied volatility. I throw a chart up here because we can see where this particular underlying, it's that 30 number, that's implied volatility, or over in the option montage, they call it Vega. That number will show up over there in the option montage in the spot month. And the spot month is basically where the most time and volume is being traded. That's the one that's right around 35 days to expiration. So what we notice, though, with implied volatility, it's forward-looking volatility. Historical volatility is hindsight. Implied volatility is expectation of future volatility, which is why I like to look at those. I like to look at forward-looking indicators rather than hindsight. But what we would see here is that we can see that there is a resistance up here, and we can say that there is basically support right in and around this area. So we would say, you know, the resistance is around 34. Let's call the support with my bad writing here. It looks like it's right around 19. Okay, so we determine where our support and resistance are. Resistance 34, support is right around 19. So what that tells us is whether the options are expensive or cheap. How? Because we can tell with volatility right here, it is at an elevated level. And the thing with volatility or Vega, it is the one major Greek that really will determine options premium on any given day. There are other ones that will fluctuate the premium or cause the premiums to fluctuate, but none more so than volatility. Like we can see a volatility move in one day from basically, we'll call that 25 to 30, so 5 percentage points. That's quite a bit. So a volatility spike will make those premiums increase in relation to that underlying. So we talked about this number right here being right around 31, and I took these screenshots at different times, obviously, so it was probably closer when I first looked at it. But anyway, we could see that it's right around that 30, 31. That's the implied volatility chart that we were looking at. So what we're saying is as volatility moves up, like this moved up 5 percentage points or so, well, 5 times 10, that means that those premiums increased by 50 cents. right? 5 percentage points. Every 1 percentage point means that the premiums will increase by 10 cents. 5 percentage points means that 5 times that Vega coefficient will increase our premiums, all right? So like 50 cents in that one day. So that is, actually it was, 50 cents in that one day. So the volatility is something we are going to be hyper focused on when we determine whether these options are expensive or cheap, all right? So again, let's go back to this. We're going to zoom in on implied volatility for a second. So let's take this. What we want to do is find those support and resistances. We've said that the resistance was 34. This line's probably closer to 19, and we are currently right at 30, right? So if you want to do the math on it, what we want to do is, for one, you can just ballpark it. If you guys don't want to do the math, I have no problem. I ballpark it all the time. Right here is at about 50%, right? You know, up here would be 100%. Right down here is 0, right? That means they've never been lower in the last, 52 weeks. They've not been higher than this in the last 52 weeks. So, that's the extreme high and extreme low. So where are we now in relation to those? Pretty darn close to the high. Well, what we do is we have a mathematical equation that we use, and it's used in TOS. Current implied volatility minus the low. Give me a second so I can think. I try to. And then we take the high minus the low. All right. Now, Thinkorswim does do this for you. But the thing is, they will also take in the entire data set for the last 52 weeks. And we know that volatility has been all over the place last year, right? 2020, that was kind of crazy. Well, coming into this year, we're still seeing that elevated level, but maybe not quite as high as what we were seeing during that Black Swan event, which probably won't happen again for another 20 some odd years. So we want to discount that odd data that like sent us out of whack there. I don't think we're going to see that anytime soon. So I want to discount that data. That's why I've kind of chopped the chart off, and I'm looking at current data in order to determine this. TOS, like I said, is going to add in that data still from the pandemic where we had extremely high volatility. So I'll show you all that as we break this down. If you want to see how TOS does it, basically you take the current minus the low and then divide the high minus the low, which is 34 minus 19. So basically we're coming up with 11 divided by 11 divided by brain fart here, 15, right? And that basically gives us 35%. Somebody wants 34.8%. All right. So that's not right. That math is not right. I just did the math in my head and that's wrong. It's a lot higher than that. Somebody else throw me out the math real quick. Let's see here. Let's get a calculator real quick. 11 divided by 5. 15, I mean. 73%. I did my math. 73%. So it's above 50. And what I say is when it's greater than 50, when this comes out greater than 50, you sell, because that means, we sell up here because the premiums in the option montage are going to be expensive, and we would buy if it were down here. All right. So less than 50% we buy. Okay. So we're way up here. We know those premiums are super expensive. Of course, we would want to sell those, right? So if we're looking at it, options are cheap or expensive. Well, we saw that they're pretty expensive for this particular underlying. So we want to sell options. And when we're trying to find that, we're going to sell options with both hands. All right. Now we've determined, right? We have a bullish pattern set up for this underlying. We have high implied volatility, so we know we need to sell those options. Now what we need to do is kind of think about our being a steward of our capital, right? Last time we said we wanted to be good stewards of our capital and limit that theta decay. Well, if we are selling something, If we are selling an option or an option, any option, what do we want to have happen? We want theta, we want theta, that thief in the night, to come and steal our premiums, all right? And we talked about this. Theta isn't binary, all right? Theta is just that thief. Every single night, theta comes in and picks your pocket, all right? Further out here, it's not quite as aggressive, but we can see inside of 35 days to expiration, theta gets very aggressive, all right? Starts really ramping up, all right? So we've already determined we got expensive. We want to sell. We want to buy back cheap, right? Well, one of the ways to help that out is to get the thief on our side. And the way to get the thief on our side is less than 35 days to expiration is the sweet spot, all right? Or right there in and around it. You don't always get 35 days to expiration, folks. But it will be as close to it. I would default to go a little bit further out in time than really kind of trying to default to, inside of here, okay? Because you've already seen a lot of this theta decay happen. I would therefore want to get out here and, take advantage of that ramp up and see those premiums really go. Out here, we talked about this last week. This is the buy zone, right? Because then we limit that theta decay. If we want to exploit it, we want to get right in here into this wheelhouse where the theta gets very, very aggressive. And we can even see this in the option montage show up, where we can see this is the theta line, right? The thief on the calls and the puts, right? The puts there, the calls here. Now, if we look at theta for this particular underline, we can see basically inside of 9 days, it's really picking up 4 cents every single night. Well, if you were to go outside that 35 days to expiration, it's only 2 cents a night, right? Well, if you go way out here at 72 days, it's really very close to only 2 cents. So if I got into this June with this trade and I was selling premium to take advantage of that high premium, right? I'm not going to get much help from theta in the next 30 days, am I? It really, maybe a quarter of a penny, all right? Or 25 cents or something like that in real dollar terms. But you can see between this time and this time, it has almost doubled our coefficient. So it's ramping up, right? So we want to take advantage of that ramp up, right? I would rather see theta helping me out rather than just not knowing I'm alive at this point. So we need to take advantage of it and try and get into that zone, into that sell zone where the thief really gets aggressive. And that is going to be inside of 35 days to expiration. We don't have that exact date. So we're going to opt to go a little bit further out and pick those 44 days to expiration. All right. That's where I would be looking to implement this strategy around a bullish assumption if I had one on high implied volatility. Now we know we're going to be doing the short put spread. This is beautiful. Why? Because we know our risk, we know our reward. We really have a stop embedded in this. If you went out there and bought the underlying, right, a stop loss, if you bought the underlying for a bullish assumption, well, your loss is wherever that stop gets executed. Well, with this strategy, we have defined risk, so we know what our risk is no matter what happens. This underlying falls out of bed, goes all the way through, opens up 500 points lower the next day or whatever. We don't have to worry about it. We can keep our powder dry. We have a defined risk strategy on. It's taken care of. If it opened up $500 lower the next day and you had a stop in and it executed at the market, you are not going to be happy. You were thinking that you had limited your risk and did not whatsoever. So when we're looking at the short put spread, we need to talk about, well, our strikes, right? Give me the strikes already, you guys are saying. Well, what we want to look at is probabilities, right? because this is really how we turn the table into our favors. If we have the probabilities in our favor, I don't care what you guys say about the odds, probabilities are the probabilities. So we can know full well what our odds are of a winning strategy immediately, all right? So what we're trying to do is set this up, and I'm not going to talk about this with skew. We can talk about that all day long, but I'm going to be looking at around this 36% line, or that half a standard deviation. This is a standard deviation line, right? Well, that happens to line up perfectly with probabilities, all right? So if we added up all of these probabilities here all the way out, it would come out to be very close to 36. And when we are talking about options, probabilities and delta are one and the same. Kind of like the thief and theta are one and the same, or vega and volatility are one and the same. All of those are just different names that people will call this. Standard deviation, it's just delta, all right? And when you've traded options long enough, you'll even talk about like bets. You know, hey, what are the odds that Kansas City wins the Super Bowl? Well, I think it's about a 70 delta, meaning 70% probability. I don't know if those are the right odds. Don't start sending me money because you're betting on that. That was shooting from the hip. So we're going to originally start to look at where we sell our put at around that 36 delta. Again, it's not always going to give us a 36 delta, folks, but we're going to start with looking for that delta, and then we'll adjust our strategy based on how much of a collection of credit we get, all right? And I'll talk about that here in a second. But delta tells us that the probability of the option being in the money at expiration. That's what I like to look at it as. That's how we turn the probabilities in our favor. Delta, most of the time, will tell you what we say, it's the rate of change to the option premium. Underlying moves $1 higher, our premiums go high, or our premiums adjust by the corresponding delta. On the floor, though, we used to just say it's data, because we like to look at it as the probabilities. All right, I'd rather look at it as probabilities. I'm not as concerned about how it's affecting my premium. I want to know the odds of me in a winning trade. So we know we're looking at that 36 delta trade that we were digging out. So if we're going to give you the strikes, we're going to start with selling this out of the money put. That's where we start to look. And then we're going to buy this further out of the money put to define that risk. All right, so we have a defined risk strategy. We aren't going to have to worry a whole lot about that. This is going to have about a 65% probability of being out of the money at expiration. So your probabilities are pretty darn good. You aren't going to get run over in this trade. But when we are looking at this put to buy, we make sure that we get our credit equals 33%, 25 to 33. I'm going to write it in there. 25 to 33% the width of the spread. Right? So in this example, let's just say, you know, this was the 100 and these were the 95 puts, right? So I've got $5 wide, right? That's $5 wide. Let's say I got $1.68 credit, right? That is right in line with that 33% the width of the spread, right? If it was $1 wide, it would be 33 cents. $5 wide, it's right around that $1.68-ish. So we would know that our reward would be that full $1.68. Our risk is that $1.68 minus the $5, right? So $3.32 is our risk on that. I got a little ahead of myself, but that's how we can figure that out relatively quickly, is we want to make sure we are collecting at least 33% the width of the spread. Or you can look at it, folks, as I'm risking 2 to make 1. All right, I'm risking 2 to make 1. All right. So if we were looking at this trade for Merck, and I did this on a chart setup yesterday, was looking for anything that had really high implied volatility. This was fitting the bill. It's pretty hard to find anything right now. But you can see that my $5 wide, I collected a $1.25 credit for this. That's on that lower end. That's closer to that 25% width of the spread, right? But I collected a $1.25 on a $5 wide put spread. And I was able to do that because we had this really high implied volatility. Market, it looks like it's going to start moving to the upside. I know where my out is. If it breaks below the candle, I'm likely going to be out there. And like I said, I set all of this stuff up yesterday before today's market action. And I am going to look to get out of this strategy at around 50% of max profit. All right. I don't mind if you guys let it squeeze out for more than that. If you have a higher risk tolerance, I'm really speaking to newer traders. The idea is to get out relatively quickly, especially on some of these trades where you're selling options and everybody's saying that maybe you shouldn't be selling options. Well, you have a higher probability of success with selling options, folks. So that's why I teach it. And if you watch the daily market commentaries where I talk about my trades, that's why you see me implementing these every chance I get, is because of the opportunity to get the probabilities in my favor so dramatically. 30% in one day, would you be out? Yes, probably. JQ. I usually look, my target is 50% of max profit. If you have a higher risk tolerance, like I said, you could say, all right, I'm getting out at 75% of my max profit. But write those numbers down, because we need to know our exit strategies before getting involved in these trades. So I like to say, you're out at 50% of max profit. Well, you guys might be saying, what's max profit? Well, max profit is going to be your credit. It's equal to whatever credit you receive. That's always your max profit, the credit received. Your max loss, we talked about that, right? The loss is the width of the spread minus the credit. All right, that's going to be your max loss. And your break even, the break even on this trade is going to be that short put minus the premium. So in our example, when we were talking about that 100 short put, right, and I collected $1.68, well, my break even would be 198.60 or 198.32, right? I think I just did that off my top of my head. But basically, short put minus the credit is where my break even is. All right. So wherever that short put is minus the break even, it gives you a little bit of wiggle room to the downside. All right. And we're getting out at 50% of max profit. Because this is a defined risk strategy, folks, I usually will let this play out a little bit longer than most strategies because of that defined risk nature. I'm going to let it meld a little bit. But you can see the risk reward. Our reward, if the underlying goes higher, is that $125. Remember, on every one lot, you have to multiply this by 100 for that option contract multiplier, because every option contract is equivalent to 100 of that underlying. All right. So our max profit would be there, and our max loss on this case would be the 375, 125, right? Risk one, or sorry, make one to risk two. All right, I have another example because I started scrambling late in the day today because my mark stopped working out. But we had something from, I think this was yesterday's, or this is today's pattern. So today I started looking at this late in the day. This is Budweiser. We have a bottoming pattern going on. Let me see if I can zoom in on this a little bit. I drag that down. So we got a bit of a bottoming pattern and a confirmation to the upside here. So we could even look at something like this with Budweiser. on this type of trade. So we could say Budweiser doing very similar trade, selling the 65-60 put spread. Then we could see that our premiums are a little bit better than that third the width. It's slightly better than a third the width of the spread. Well, what happened during the life of this was, it was interesting. I started actually seeing volatility come out a little bit, and we saw those premiums come out as well. It wasn't a ton, but it did come out a little bit. So you can see that I took a snapshot really close after that, and it dropped by 6 cents or something as the volatility started coming out. So that's another reason why it's really important to get involved in these. The underlying didn't trade a different price, really. It was just that volatility coefficient affecting those premiums. So something like this, we want to make sure we get involved in it when it is relatively elevated. And we could see on this one, as I zoom back out, the volatility just went through the roof. I mean, it's at 100% here. So we know the premiums for Bud are extremely expensive right now. We can take advantage of that. So that would be something we could do as well. Selling, and as a matter of fact, I'd probably do this one if I'm going to do a trade tomorrow, do this trade versus the other one. Another thing to note, I don't normally do these trades when there is an earnings in the option contract that I would be trading right in here, okay? So I probably wouldn't do Bud for that reason either. I'd like to try and have a clean month here where I'm trading it. Because why? Volatility, when I'm buying options, I don't care as much because that volatility is expected to expand heading into that binary event, all right? So when you head into those types of events, you will see volatility spike like we saw right here heading into this event, right? That's that binary event. Well, we're heading into another one. We'll probably see these volatility coefficients remain elevated and maybe even go higher. So I would want to stay away from this strategy around this underlying because of the earnings only, all right? So try not to get involved in that. It will make that not work out as well as you could be directionally right. The volatility is still cranking up. The market's still going higher. Volatility is cranking up. Basically, it would be offsetting your directional move. All right. So we want to try and get involved in this when volatility is high. All right. To make sure we have a good risk reward. You guys have any other questions? So this would be a perfect one for a swing setup. I mean, they got the bottom candle, you got the confirmation here, extreme high volatility. I would be selling basically the put spread below this 50-day simple moving average, or my break even at least would be below that simple moving average. So I would be very happy with a trade like this. Obviously, I would look to get out if it breaks below this 50-day simple moving average, just like we would with a regular swing trade, okay? But if it gaps lower, right, then, you know, we've got this defined risk strategy. It gaps lower and goes all the way down to, let's say, 55 or something, right? Well, we don't have to worry about the strategy anymore. We already know we got our max loss. We're already out of it. We don't have to worry about it. You might have to worry about somebody coming in and you've got that short put. Well, if you got a short put, remember that means you're willing to buy that underlying much higher. We've offset that risk by buying a put. We have now the obligation. We can offset all of the stock that way. But rather than go through that whole process, just if it gaps down, you're at that max loss, just cut the trade off and move on with your life. Find another high opportunity trade. Okay. All right. So Bud is probably at this point today a better example because today with my Merc, it started falling off late in the day and I don't even know where it ended up finishing. All right, so that's it. If nobody has any other questions, if you do, I will make sure you're clear of concept before we shut out this webinar. I'll move on. But if you guys want to take advantage of this, this is our options lab. You get everything and you get me, folks. You get me as a mentor. You can reach out to me anytime with questions, comments, or if you have an idea you want to run it by me to see if it fits in line with my guidelines to trading these options, I will be more than happy to talk to you. If you have an issue where a trade is going against you, how you stay mechanical, I'm your man. I've got you. All right. So you can reach out to me. If I can't respond in a simple email, which I hate typing, I'd rather call you and say, hey, let's get on the phone. Let's talk this through. And you get VIP Options Lab membership status, which entails all kinds of good stuff. I'm going to throw this over there in the chat window for you folks. You can click on that hot link. It'll take you right to the cart there where you can click on this for the first 100 members. All right. I'm not going to go over 100 members. I did that one other time and it got a little crazy, but I want to limit that so that I can make sure that I cater to you folks. All right. So for $97, if you're watching this on tape delay, you will have to pause and punch this into your URL. For you folks watching it live, we got it over there in the chat window for you. All right, thank you all for joining me in this webinar. I appreciate it. Later webinars, I'll drill down on different option components, when, where, and why. And there's the link. Also, if you have any questions, comments, or ideas for future webinars, reach out to us, 310-598-6677, or trading@protraderstrategies.com. Finally, yes, I got one too. Yeah, it's right there. The disclaimer. Please take a moment to go over that. I'm not trying to get you guys to do these trades that I just talked about. We are just using these as examples for you folks to learn. All right. So here again is the link for the Options Lab. That gives you basically everything. My daily market commentaries, you guys will see every single trade I do, when, where, and why. And I'll talk about some of these rules around these option strategies as well. All right. So to keep you up fresh on those. All right, Alexander, take care. Appreciate the kind words. You guys all take care for now. Like I said, yeah, it should be over there in the chat window. There's a link there for you. Go ahead and hit on the hot link. I don't put it in the questions box because it doesn't create a hot link for you. All right. All right. Bye for now, you guys.